Hey everyone, welcome in our latest Trade of Black podcast. I'm your host, Shad Deals. Earnings seasons rolls on. Our next up is Chicago Atlantic, who reported their latest earnings earlier this week. Some of the notable numbers included 34 cents a share. They matched that with a 34-cent dividend. They also have $125 million in cash, and in their portfolio, all their borrowers are current, which is impressive in these market conditions. So how are they doing it? Let's find out as we bring in Peter Sack. But first, let's welcome in AV here on a Thursday afternoon. Good to see you. And we've been reporting a lot of companies, and the common theme I keep saying is we're holding our ground. It's good to see.
Yeah, it's good to see. Good to see both vehicles on the Chicago Atlantic front, both LIEN and refi, performing well. Both of them are stable, and unlike a lot of the other stocks in the industry, I mean, they pay a dividend, and they pay a continuous dividend that's been good for some time now. It's great to dive into both of these names.
And all their borrowers are current, which is very impressive. So with that, let's welcome in Managing Director of Chicago Atlantic, Peter Sack, back to the live stream. Good day, sir. How are things?
Great to see you guys. Life is wonderful.
How's it going?
Yes. Like I always say, before we get into company details, what do you think? A lot of interest and a lot of attention the industry's getting. It's nice to see. Before we got going here, it was just like, wow, I remember what these days were like. And it kind of makes you feel it's been a long time. But regardless, here we are, right?
I love the enthusiasm. I love the new interest of capital in the sector, and I love the new enthusiasm that operators have to invest, to build new facilities, to acquire, to divest things that aren't an ideal part of their portfolio. It's a catalyst for activity, and activity benefits us.
What do you think, and again, we'll get into company details, but with an announcement like this, there's certain things, there's myths, there's facts about what rescheduling does. Well, one thing it will do is draw a lot of interest and attention back into the space. What are you anticipating from a business standpoint based off of an announcement like this? And I want to emphasize if it happens.
I think if it happens, we're going to see just fundamentally a lot more activity. I think if it happens, valuations increase, free cash flow increase, investment increases. All of these I put under the bucket of activity. And that leads to more activity for us. That means that we will be financing more deals and more companies. That means some of our borrowers will be doing acquisitions or getting acquired or doing refinancings that get us taken out. And all of that activity benefits us. When we get refinanced out of a position, that's good for us too, because we take early prepayment fees on those positions, and then we get to redeploy it and put it into new loans that include more fees and more revenue generation opportunities. So activity is great for us, and that's why I'm really excited about the enthusiasm around rescheduling. Rescheduling is it's extremely helpful for our borrowers, profit and loss, and for their valuations. For us, we focus on investing regardless of whether rescheduling exists. So from an interest rate perspective that we charge our borrowers, cost of capital perspective, not necessarily is going to drive a significant change for us. But what it does drive is activity and market growth, and that's what's really exciting.
With that activity, do you see it impacting the LIEN side of the business with the BDC more than the refi side of the business, as you are being able to, I guess, more dynamically invest on that side with those debt instruments predicated more so on the operations of the actual companies versus the real estate side with refi?
It really drives both. It really drives both, and ample liquidity across both. And our opportunity set in our pipeline grows for both sides pretty congruently.
Yeah, well, you said that you'll see a lot of activity. Maybe explain to our viewers that if you're doing well and you're busy, this is actually good for the industry. Maybe elaborate off of that so people have a better understanding of what you're referring to.
Yeah, it's by activity, I mean companies investing in their operations by building out new facilities, by building dispensaries. I mean companies doing M&A, acquiring other businesses. And in M&A, there's a buyer and the seller. So that means you need a willingness to buy and invest and optimism in the industry. And you need a willingness to sell. A seller has visibility into what their forecasts are and thinks now is potentially a good time to sell. Or now is a good time to optimize my footprint by selling one part of my business so that I can focus on another. And a key obstacle to all of this activity in the market is uncertainty.
Right, of course. And something that we know very familiar with, right?
Mm-hmm. And so clearing up uncertainty, whether positive or negative, can drive further activity. I think a positive example would be rescheduling, going through and having a clear path and timeline for when rescheduling is going to occur. But negative changes can be good for activity too. For instance, Florida adult use not passing. I would have much preferred, and the industry would have much preferred, that adult use pass in Florida. But just the answer that it did not pass clears up a certain level of uncertainty and allows people to start making decisions about whether to invest XYZ in their Florida operations or to invest elsewhere over the next 2 years. So just ending uncertainty and having clarity allows management teams to make clearer decisions, and that drives opportunities for us to support those decisions through financing.
Funny you say that, because that was something I said the other day. I was like, no matter what happens with rescheduling, whether he punts it or whether he drives it home, the uncertainty is now taken out of the equation. So there can be business decisions made on a go-forward basis, because everyone's just been wishing for years now, since it was initiated. Do you think that if we do get rescheduling, and I know that on the refi conference call, you were talking about some of the prepayments that were coming in, do you think it accelerates some of those prepayments as companies will have more free cash flow to start servicing some of these debt facilities?
I think it's not. I think the relationship isn't that direct, that more free cash flow leads to more repayments. I think it's a little bit more indirect, that more free cash flow leads to a broader range of opportunities more generally. That it leads them to be able to consider making acquisitions, making transformative investments that then really transform the free cash flow profile of the company in order to make a step change. And generally with our relationships, we're quite ingrained in the company. There's a lot of switching costs into moving your lender. And so it tend to, in the case of marginal changes, tend to stick with existing relationships, and we do our best to maintain those relationships really well. And the refinancings tend to occur when an operator is making a really dramatic strategic shift.
So $125 million in cash, and all of your borrowers are current. Make me or help me understand that more. We've hear a lot of concerns pertaining to that side of the business in the industry right now, but it's impressive given the current market conditions that we have been in. So maybe explain to our viewers how that is happening.
Well, we have 33 borrowers spread across the country with an investment thesis that's focused on low leverage, underwriting existing cash flows, not focused on potential unknown catalysts such as state level regulatory changes or federal changes. And that consistency of making loans based on ability to service indebtedness and actual cash flow and the diversity of those cash flow has allowed us to remain consistent and perform consistently when the cannabis operators are valued at 15 times EBITDA and when they're valued at 4 times EBITDA. And it's the ephemeralness of value. It's that risk of valuation that we've been able to avoid. Because the fact is that a lot of value 4 years ago did turn out to be ephemeral in different conditions. With a focus on cash flow and the certainty and diversification of those cash flows, we can build a much more stable and resilient portfolio.
Do you think within the industry that if we do see a step change in federal reform right now, that you start to really catalyze consolidation within the industry amongst, let's say, some of the single state operators and the smaller operators getting folded up into some of the larger, more dominant players nationally?
Absolutely. I think we've seen and supported a lot of that already in operators in Missouri and Maryland. I think there's a number of restructurings ongoing today of balance sheets that are over-levered. And part of that process will be those over-levered companies selling pieces of their portfolio, if not the whole portfolio. And it's a positive catalyst for us because we can finance those purchases and take what are cash flowing operations and really strong operations, but just sit within an over-levered balance sheet. When they put into a more healthy and solvent balance sheet, they represent really strong opportunities for us. And so when you see some of the news around restructurings and companies that are creating sale processes to sell their assets, it's a healthy part of the business and it's healthy for us, A, because it presents opportunities for us to finance those transactions, but B, it also creates more rational operators. Over-levered
Correct.
businesses have warped incentive structures that lead to not necessarily rational operators in the market.
Mm-hmm.
And so I think that this shakeout is a positive catalyst for the industry more broadly.
Yeah, absolutely.
And you think that is front and center? Pubco companies is what you're referring to when it comes to M&A. It's not just the private side, correct?
Correct.
Yeah. How soon do you think that happens?
Well, I think a number of these processes among some of the public companies that have been reported on this cast are ongoing and should be completed certainly within 12 months and probably a lot sooner.
Yeah, so you're starting to see that already, and you think that only manifested even more as the year progresses, especially off an announcement like this, is what you're thinking.
Yeah, I think for a lot of these processes that have already started, restructuring processes that have already started, rescheduling doesn't change the dynamic,
right?
Because it's just too late, and so I think we'll see those restructurings occur, and it seems like they're occurring in a relatively orderly fashion, which is great. That means waste in restructurings. Waste in the context of restructurings comes in the form of missed operating opportunities and in the form of friction of transaction costs and lawyer reports. And to the extent that these processes can go more smoothly, we minimize those risks, and that means more capital can go into value creation.
How's New York? How's New York coming? I mean, I know that you guys were one of the bigger players in capitalizing that market upon inception. I know we just had a big headline last week with the OCM going after, it might have been 2 weeks ago, with the OCM going after certain operators on a retail basis. They then walked that back. I mean, is there any color you can give us in New York on how it's going and how it's looking from an operator perspective currently?
Yeah, absolutely. We're strong supporters of the New York market across the spectrum. We've supported Fluent's business in New York, supported Vireo's business in New York, and we supported the New York Social Equity Fund's business in New York. And I think that there are certainly growing pains as the state and the regulators try to create a regulatory system that aligns with the state's administration's values. Mm-hmm. And it's a painful, rocky path to create that system. But ultimately, the fundamental trend is positive, and that's more dispensaries opening, further growth in the market. And I think the most powerful thing about New York is creating a regulated legal market that competes with the illicit market.
Of course.
Yeah. And in order to do that, you really need three things. You need dispensaries open within a 50-minute walk of major population centers. Mm-hmm. And that's happening more and more. There's more than 300 dispensaries open today. Yeah. You need high quality product that's indoor product grown consistently and available on the shelves consistently year round. And that's a work in progress, but you're seeing more indoor cultivation enter the market every month. And then the third is prices, including taxes, that can compete with the illicit market. Mm-hmm. I think that's there now, because fundamentally the illicit market is not competitive. Its products are inconsistent. They're of dubious quality and inconsistent quality, and not necessarily competitive on price. And so against that backdrop, and this is the fundamental thesis that's driven our investments in New York, against that backdrop, I'm really confident in the market fundamentally.
Yeah. Do you see New York rivaling California or rivaling Florida in the next couple of years in terms of total addressable market and growth? You think it does get there with scale? Yeah, absolutely.
I think it'll eclipse Florida soon.
I was going to ask you guys, do you think it's, I don't want to say easier, but they can combat the illicit market in New York more efficiently than what they do in California?
Well, you have distance on your side.
Yeah.
Distance helps.
Yeah. Proximity in Manhattan. I mean, we saw Operation, was it Smokeout or Choke Point or whatever it was, where they just started padlocking all the illegal dispensaries.
I know.
It worked greatly because everything was so dense.
Yeah. Well, and enforcement is powerful, but the market drivers, I think, are even more powerful. Proximity to legal locations, quality product, and competitive pricing is a much more efficient way to combat the illicit market. Enforcement helps too and is important too, but in the long run, we want to see a sustainable legal market grow.
No kidding. I don't know if this is part of their business plan as far as the rollout. And if it was, you'd have a hard time getting investors if the New York state officials were trying to say this is the rollout of cannabis over the years, because it's been anything but perfect. But the reality is that we all want it to win. We all want it to succeed. And I think, there's been a lot of trial and error for sure. But as you just said, this could be a massive market like Florida, and let's hope it one day does. Let's get into some of the numbers. You brought in $7.7 million in net investment income, 34 cents per share, as I said off the top. Pay that exact amount in dividends. NAV ticked up to $13.23. Investors like a fully covered dividend for sure, but they also want to see if it's built to last. So how confident are you to sustain that for the rest of the year?
Yeah, we're focused on deployment, and we've got a great opportunity set, a great pipeline. Current dividend is we have a lot of confidence in, and we're really confident in the opportunity set that we have in front of us.
Okay.
How is the pipeline? I mean, with the structure of LIEN, how is the pipeline? Is it all through the value spectrum of businesses? Everything from these opcos to brands. Like, how's the pipeline looking in terms of structure?
The pipeline is among the largest that it's ever been.
Okay.
I'd say there are a couple factors driving that. One, since we formed the joint venture in the fall of last year, we added Chicago Atlantic's non-cannabis portfolio pipelines to the BDC pipeline. Mm-hmm. And so that's going to range between 20 and 30% of the portfolio, and that drives a diversified set of opportunities. The second development that we've seen in the cannabis markets in the last 6 months has been twofold. One, the emergence of some of these financing some of these restructuring opportunities. Mm-hmm. And two, the emergence of a number of private operators pursuing ESOP transactions.
Yeah, we talked about that before.
And so I'd say those are the two new fundamental dynamics driving our pipeline. I'd say in addition to that, in some of the mature markets in which that we have historically avoided, we're also starting to see greater consolidation and strong operators rising to the top in places like California, Oregon, Washington. And particularly in retail, where you can see strong, diversified operators of multi-site retail with consistent earnings generation, we're interested in backing some of those players. Okay. And a lot of the risks that historically have been associated with unlimited license markets can be mitigated with a diversified footprint of retail with strong geographic moats, at least from a debt perspective.
Yeah, that's always been that's always been my argument to people. People are like, well, California, Oregon, Michigan, Washington, they're kind of like foregone markets. And I'm like, guys, someone has to be making money. There are strong operators in these markets that do rise to the top and that do generate cash. You just need to find them, and they have to have generally strong moats. One thing you mentioned that was accelerating the pipeline was the ESOP. I don't want to call it a trend, but I mean, we've seen ESOPs mentioned a lot amongst the cannabis industry, let's say in the last couple of quarters. Do you think that trend is almost a little bit too late, as I know a lot of these companies are using it to mitigate 280E, and if we do get rescheduling, 280E being nullified would almost reduce the efficiency of that ESOP structure to a certain degree?
Yeah, absolutely. I mean, I think if the path for 280E becomes much clearer than it is today, that you won't see new operators pursuing the ESOP path. Yeah. I think it's too early to tell how real this instance of rescheduling conversation is, for better or worse. I love the enthusiasm, but so far we have 2 or 3 data points from the Trump administration and then a big echo chamber.
That's
and
true.
I'm hopeful that it develops further, but we have been here before.
Yeah, absolutely.
One can only hope. I know we've had these conversations earlier this week, Anthony, about how, lawmakers could be looking at this differently once rescheduling happens. We have heard that. I hope that is indeed the case if and when this does get announced, because having a conversation with the senator, or congressman, or woman that's not on board with cannabis and it's now classified as a Schedule 3, you'd think on paper they would start to look differently at this space, but you won't know until that comes. Still think it's going to be, there will be some curveballs for sure still, even in the event this does change, but we'll find out either way, right?
Yeah, I sure hope so.
Yeah, that's for sure. Next up, you following Jerome Powell much lately? Looking at these interest rates right now. I bring that up because I know a lot of your loans are what's called floating interest rates. So you want to explain how that works, and in the event that we do see interest rates do fall, hopefully, what does that do, or how does that impact the company?
Mm-hmm, mm-hmm. So we tend to originate our transactions, the vast majority on a floating rate basis, and north of 80% of the portfolio in LIEN, or about 76% of the portfolio has floating rates.
Okay.
What's unique about our floating rate loans, however, is that when we originate a loan, we set a floor on that interest rate that's equal to the benchmark on the date the loan closes. And so if the prime rate, as an example, is 7.5% today, that will be the floor or the lowest that that benchmark can go in the future. And so our investors have exposure to the upside should rates go up, but are protected from the downside should rates go down.
Okay.
And about half of our floating rate portfolio, a little less than half of it is already at its respective floor, and so is not exposed to interest rates going down.
Well, let's find out, because I know that Trump and Powell are not on the same page right now. But one thing's for sure, President has definitely pushed him a lot right now, is he not?
These are some extraordinary times we live in.
Yeah.
Yeah, that's for sure. Let's look at your portfolio. When I look at this, it can, let's face it, make or break a lender's result if one large borrower stumbles, which we're seeing in the space right now. $307 million across 31 names. Is it 31 or 33?
33.
33. Top few positions, they carry real rates. So how much of the portfolio, I guess, is tied up in your 5 largest borrowers? And is that concentration where you want to be, I guess, really?
Yeah, I'd say the 630 portfolio needs to be viewed within the lens of subsequent payoffs. That we had our second largest position actually paid off in Q3 as a subsequent event with a prepayment penalty. And so that concentration within the top 5 names in the portfolio has gone down significantly quarter over quarter.
Okay.
That being said, I think the key theme of our largest positions is the diversification of the EBITDA in each of those companies. Mm-hmm. Those businesses are multi-state operators with cash flow generation arising from multiple sources, and so while it is a single position, its underlying downside protection is driven by multiple relatively uncorrelated sources. And this is one of the unique credit aspects of the cannabis industry, that when you're lending to a multi-state operator, the profitability of one state is relatively uncorrelated from the profitability of another.
Yes.
Your assets in Maryland are distinct from your assets in Florida, are driven by a supply and demand dynamic of the regulatory and competitive environment in each of those states. And if there are 1,000 new dispensaries that come online in Florida, that doesn't impact your supply and demand dynamic in Maryland. And there aren't many industries and business models that operate like that in the U.S. And so it gives incremental downside protection to a lender, because you can seek recovery from an individual asset, even if another piece of the portfolio has declined significantly. That cross collateralization creates a sum of the parts lens that is much more powerful in this space than others.
That's an interesting point. I've never thought about it like that. You're almost getting like bifurcated risk from a lending perspective, which you can pick and choose which markets you want to be a part of, unlike equity where you have to invest in the entire mothership. You get optionality in where you want to choose.
Exactly. Optionality in the downside. Now, from an equity perspective, I wouldn't view it as necessarily positive because of the challenges of creating synergies and cost savings across a diverse footprint. But from a credit perspective, the divisions of those markets, the segregation of those markets creates a powerful tool for us to use in our underwriting and portfolio management.
Yeah. Balanced approach across multiple states. Have you paid much attention as to what's going on in Texas right now?
Yeah, I think it's some exciting developments. Exciting developments in terms of pushing the ball forward of their regulated medical market.
Yep, of course.
And I think it's nice to see a debate around the hemp markets occur in a public setting and in a place like Texas, because you see all of the various viewpoints come out in the public sphere, and we get to hash them out as a culture and a society together. So I think it's a really healthy process, whichever way it goes for hemp markets in Texas, and just seeing that brought to the forefront of the national conversation is helpful for everyone.
Yeah. Well, once we get some regulation or some clarity, as you've said before, from Washington on this farm bill over the next 12 months, what do you think of, like, and forgive me if you have been doing stuff like this, but what do you think of the overall hemp industry, and does it present business opportunities for you down the road?
Yeah, I think I'm particularly enthusiastic about the hemp beverage market, that the distribution channels that they unlock through places like Total Wine. It opens up a segment of the market that the regulated dispensary channels have never been able to tap very well. Beverages have never been that large of a piece of the market through the dispensary channel. And so I think that the buyers through these new distribution channels are not cannibalizing. I think they're expanding the pie, expanding the market, and bringing new consumers into this broad THC ecosystem.
Of course. Yeah. Have you had conversations with people in that space? Like, I'd love to understand in some ways, like, what's different about them compared to cannabis? Because we all talk about how we got to stop this divide and work amongst ourselves, because regardless of which way you look at it, they're both attached at the hip.
Yeah, I think particularly in the beverage market, the aim of some of the largest operators in the beverage space that we've spoken to is to create a new market, create a new user, and a new consumer that replaces alcohol consumption. And with that goal in mind, in the beverage space, the ecosystem seems to be relatively responsible packaging, clear doses, trying to create a product that is sustainable over the long term and doesn't try to capture some fad by having fancy packaging that might allure to children, as an example. And so I'm really enthused by some of these very responsible scaled operators. They're investing a lot of capital. From our perspective, from an investment perspective, the beverage segment is generally still too small for us to find a lot of opportunities. We tend to lend on existing cash flows of a relatively stable or at least somewhat scaled operation, and there aren't very many of those in the beverage space yet. But we're building a relationship so that when they do reach that level to be suitable for debt capital versus equity capital, that we're prepared to support them.
Have you looked into the manufacturing infrastructure around hemp beverages, or is it more so the manufacturers that are doing it right now, they're already scaled, they're going to use pre-existing infrastructure from, let's say, canning and bottling from the big beverage manufacturers, and there's really no reason for incremental capex to be deployed to manufacture something, let's say, called niche, like a hemp beverage?
Most of the individuals that we've spoken to are creating new infrastructure for bottling. They are. The process of bottling is well established. This isn't a new. It's not a revolutionary process and field. So from that perspective, a lot of the, I think, capex requirements for a bottling line are simply not that tremendous. Regardless, is nowhere near the capex investment needed for cultivation facilities, as an example. And so I haven't seen a lot of co-packing organizations take on hemp brands necessarily. I've seen more new upstarts creating their own bottling line.
Got it. Yeah, because the reason why I was asking is I've looked into it, and I mean the economics around producing the can to what they sell to a distributor, the economics are quite grand on a unit basis, and then also with the big beautiful bill now, you can basically get those tax breaks on the manufacturing equipment in year one. So I mean, if you have your operation dialed in and you're really taking advantage of everything to create that infrastructure and start to scale it into the industry early, could be advantageous, especially as you mentioned, it's relatively low capex to get started on a bottling and canning line.
Yeah, I think we're also still trying to understand how much of the economics of the supply chain will accrue to a manufacturer versus distributor versus retailer.
Right. And as you said off the top, you need some clarity because until we have that, there's still some unknowns, which explains the economic portion. Listen, great latest earnings. And we keep saying this, that the industry is holding its ground, and even more so in this latest earnings report. But it's good to see. And you add in the reform rumors. Talking to a lot of people this last week, and everybody's got their fingers crossed, because if we get this kind of announcement, it's really going to turn into a very eventful back end of 2025 and perhaps beyond. But hopefully we're on to that next chapter of this story, right?
Hope so.
Yeah. Listen, always appreciate catching up with you. Appreciate the insight, and let's keep in touch, okay?
Likewise. Thank you both.
Thanks Peter.
Hey everyone, we just eclipsed 50,000 subscribers on our YouTube channel. We want to continue to grow this community. So if you haven't done so, make sure to subscribe now. We'd appreciate it very much here at the TDR Traded Black podcast. As usual, let's keep the conversation going. So leave your comments below, and we'll get back to you with any feedback that you want to learn more of. In the meantime, enjoy the rest of your day, and we'll see you next time on our latest Trade to Black podcast.